What is a credit score, and what steps can you take to improve it? Should you even care what your credit score is? I'll show you the details coming up next. Credit reports and credit scores are two useful tools to help you monitor your financial health. Of course, you already know your credit health is important if you plan to borrow money. But you may not realize that your credit can also affect your ability to rent an apartment, purchase insurance, or even get a job. Credit reports in the United States are compiled by 3 competing companies: Equifax, Experian, and TransUnion. Each of them will provide you a copy of your credit report free of charge. A credit report contains a detailed history of all of your transactions related to borrowing money. For example, if you have a credit card, your report contains information on the type of card, when it was opened, and the credit card's credit limit. But it doesn't end there. The report contains information on the card's outstanding balance, a detailed history of every payment you've made, and more importantly, every payment you've missed or you've paid late. These records are compiled for every credit card you have now or you have had in the past. It also compiles the same information for every car loan, bank loan, student loan, mortgage, cell phone contract, utility account, or really any type of account that requires monthly payments. Your report also could include tax liens, legal judgments, and information on outstanding child support. The report retains information for up to 30 years, even on accounts that have been closed. Negative information, though, is generally removed after 7 years. The purpose of a credit report is to give banks enough information to determine if you are a good risk to loan money to. But there is so much information in the average person's credit report, banks began asking for a simplified way to determine credit risk. This is where your credit score comes in. The most popular credit score is FICO, which ranges from a low of 300 to a high of 850. A credit score compiles all of the positive and negative information on your credit report and simplifies it into a single score. The higher the score, the better your credit, leading the bank to believe that you are more likely to pay off your debts. So why should you care? When you borrow money, you represent a risk to the lender. If you have a history of not paying your debts, you represent a greater risk. Lenders will charge you more to borrow from them. Let's say you want to borrow $30,000 for 5 years to purchase a car. Your payment on a 6% interest rate would be $580 a month, and you would end up paying a total of $34,800. A 7% interest rate would cost you $594 a month, and you would end up paying a total of $35,600. How do you feel about paying $800 more for the same car compared to the next customer? A better credit score means a better interest rate and lower total cost when you purchase on credit. Even if you have no plans of borrowing money, a low credit score can lead to higher insurance premiums, more scrutiny on rental applications, and could even cost you that new job you just applied for. So how do you improve your credit score? Your credit score is made up of 5 components, all of which you can improve over time. 35% of your credit score is based on your history of paying your bills on time. Create a calendar of all your monthly bills. Or better, use one of the many apps out there that have features that remind you when to pay your bills. Banks want to see a history of on-time payment. 30% of your score is based on your ability to maintain a reasonable debt ratio. Keep your outstanding balances low. Just because you have a card with a $10,000 credit limit doesn't mean you should be making $10,000 worth of purchases. Keep your balance below 30% of the limit. Banks want to see that you can manage your credit responsibly. 15% of your score is based on the length of your credit history. Keep accounts open for at least 2 years. Banks want to see that you have a long history of on-time payment. No credit history is worse than a bad credit history. 10% of your score is based on the variety of credit types in your report. Banks want to see that you can handle different types of payments. Someone with on-time payments on a car loan and a student loan and credit cards and a mortgage will have a better score than someone with just a single credit card. 10% of your score is based on the frequency of new accounts that are opened. Pace the timing between opening new accounts. Opening many new loans or credit accounts in a short period of time is a red flag that you're out of control. It's important to monitor and improve your credit score over time. It will lead to better interest rates and lower monthly payments on major purchases. Better credit scores can also lead to better rates on insurance and rent, and monitoring your credit score and your credit report can go a long way to preventing identity theft. Please subscribe to my channel below. I'll be uploading new weekly videos covering financial planning and taxes. You can also visit smartzonefinance.com for articles on taxes, investing, insurance, and general financial planning.